Our panel today is to look at what's happening to the venture capital industry. And in keeping with the best of times, worst of times, or sort of the good news, bad news meme that seems to be emerging in the conference this morning, I thought I would start, being the good old-fashioned journalist I am, with the bad news. The bad news was that last year, the venture industry sort of hit a trough. There was just over $41 billion of money committed, but that was 20% lower than last year. The deals were smaller, the rounds smaller, there were fewer deals, they were more concentrated in a more limited number of places. I mean, it's remarkable that more than half those funds were allocated into just 5 parts of the world, 3 of which are in the United States. But there are signs that, and also the other last part was that exit strategies were getting a lot tougher as well. There are signs now that that's all starting to turn around and move in the opposite direction. So I think one of the things that we're hoping to examine on the panel this afternoon is what are the drivers propelling that, and what are the challenges and the impediments in its way. And I will start off by asking each of the panelists to very briefly introduce themselves and to address those 2 specific points about what's driving the turnaround and what are the greatest challenges that they see. So very briefly, before they introduce themselves, let me introduce, we have Mitzi Ushio, Managing Director of Harris & Harris on my immediate right, Nancy Fund from DLB Investors on my immediate left, and Tony Lent from the Wolfenson Fund Management on my extreme left, as indeed you can see. Their bios, full bios, are in the folders that you have, so I won't waste any more time on that, but let's dive straight into it. And Mitsio, maybe you could get us underway and give us a sense of what are the drivers now in the industry and what are the big challenges that you see?
Sure, so I'm Misty Ushio, I'm with Harris & Harris Group. And just a little bit about our group, because it is a little different. We're not a traditional LPGP fund. We're publicly traded, and so we have an evergreen model. And we are committed to early stage investing in kind of fundamental science. So we invest in life science, energy, and electronics. And that strategy, we've been doing that for 30 years. And like I said, we reinvest our gains. And so the evergreen model is great. We're always a little capital constrained, I would say, because you never really know when those exits are going to come. So we try to meter that cash out appropriately. But what have we seen? It's hard to invest in companies that have a lot of technology risk and get them to exit. And so because it takes a long time and it takes a lot of money. And so as we think about, okay, if we're going to commit to the early stage investment thesis, knowing that that's a big challenge, how are we going to do that differently? How can we keep the capital in these companies low? And how can we exit sooner? And it's easy to say, hard to do. And one approach we've really taken over the past, say, 12 to 18 months is to really think about working more closely with corporations, because corporations have a lot of cash. They had a lot of cash, and they've been hoarding that for the past 5 years, and now they're ready to think about how to spend that or how to invest that. And I would say we've talked to probably 80 companies over the past 18 months, and only a subset of these are really thinking about how to invest in innovation over the next 5 to 7 years. But the ones that do, and in the areas that we're in, they make really great partners, because we sort of bring our technology expertise and company building expertise with their scale in manufacturing and end market analysis. And the theory is that if you do that at the early stages, can you exit earlier with fewer amount of dollars? But you need to keep it really tight so that you don't get too much invested in too early. I'll stop there, but could elaborate later.
I think the advent of greater corporate investment in the sector is actually one of the interesting themes we might want to explore later. Nancy, how does it look from where you stand?
Well, I think there are segments of the venture world that are experiencing some liquidity issues, and that could result in fewer funds being raised and such. But there are a lot of niches within venture capital that are quite strong. our firm, DBL Investors in San Francisco, pursues a strategy that used to be unheard of and now is gaining some momentum, which is to combine top-tier financial investment returns with social returns, and be those in climate change improvement or other kinds of social improvement. And we feel that that the interest in those kinds of investments is increasing, and that the deal flow is rich and diversified and growing every day. So I would say that that's a pocket of venture capital that is quite healthy. It's not as disciplined as some of the more traditional sectors like life sciences or digital media, but it has a lot of merit to it. Certainly digital media is very strong, and clean tech, even though it went through a very difficult period over the last election cycle, is coming back, and you're seeing some very strong performance on IPOs in that sector, like a Tesla Motors or Solar City or a SunPower, and even First Solar has done better. And there's nothing like a positive climate in the public markets to help venture capital, because really that is a big source of the exits, even though many acquisitions end up being the way venture investments get liquid. It's the companies that go public that kind of define the industry. And so I think that, with the Twitter IPO happening and just more, even life science companies that have had no access to the public markets until very recently are experiencing more demand, and you're getting some small IPOs done. So I'm more bullish on venture capital, but you have to be really selective in terms of which sectors you go after, and you don't want to be in a sector where everyone's chasing the same deals and raising the prices and kind of undermining the economics, which we've all seen that movie, and it's one that we need to avoid. But I think there's a lot of opportunity ahead if you're more selective in the way you invest.
Tony,
we're an emerging markets focused fund. We do growth equity primarily, and we do some venture. But I'll speak to the category as a whole. We invest in financial services companies. We invest primarily. We underwrite entirely on a returns basis, but we do invest in financial services access and high impact businesses, both in emerging markets and developed markets. What I'd say, just in terms of putting a frame around the industry, I think it's important to realize that I think one of the reasons why capital is scarce is that median returns across the venture capital industry have been pretty poor since the dot-com bust. If you look at the long-term return for the average venture fund, it's been in the low single digits. Private equity hasn't been a lot better. If you look at the average return for private equity, it's been around 7%. So I think this is one of the reasons why capital is increasingly scarce. I agree with everything that Nancy said in terms of there being pockets of opportunity around differentiated strategies. But I think it's really important for investors to understand that the capital scarcity is driven by that structural issue. And on the other side of it, you have to understand that the primary investor right now in venture capital is a pension fund. And pension funds are really incredibly focused on making sure that they preserve capital. They want to have high returns, but they want to preserve capital. So for general partners that I know around the world and in North America who are being successful raising capital, they're going beyond their traditional fundraising channels. You're seeing a tremendous amount of creative deal making in what I would call the institutionalized family office market, with multiple strategies being underwritten that are not happening in the mainstream venture business. And I would agree as well that strategic corporate venturing is seeing a significant reflowering and a huge amount of flow of capital, not the likes of which we haven't seen since like 2000. So I think all three of those factors are important in understanding where the industry is today. In terms of if it is at the bottom or not, I think it probably is at the bottom, but I think in some respects it's good to have a weeded out market in the sense that there's not as much noise in the market, and people that are specialists can focus on what's in front of them rather than noise in the market.
Does that mean then there's a
sort of drift on the part of investors towards the, let's say, the brand name funds, the well-known funds, and is that depressing the range of potential investments that could be seen?
I'll let my other panelists answer the question as well, but I think across the entire investment landscape, from private equity to asset management to venture to growth, you've seen a massive concentration of capital formation over the years since the financial crisis. That's I think it's part of a natural ebb and flow of the capital market cycle. But for now, brands are king, and they haven't started to end at this point.
But I do think that if you're a brand in venture capital not having recent returns, you can't rely just on your brand anymore, because there are up-and-comers that have good returns. And, this is it's a meritocracy, this business. I mean, you are only as good as your kind of last fund. And so while there's an advantage to having an age-old brand in this field, it is open if you've got, accomplishments to prove it.
Yeah, and I'd probably echo that. But, because we're public, we don't see the normal LP. However, we keep a pulse on it, and what we've heard over, say, this past 1 to 2 years is that so limiteds, if they invested in 7 venture groups, are going to go down to 3 venture groups or 4 venture groups, and it's all driven by the numbers. And so I've found that even if you're new, it's hard to penetrate to be the new name in LP that has traditionally invested in venture. That said, I think there's a few that do, because they go strictly by the numbers, and because I think the data shows that first fund, second fund, maybe third funds usually show good returns, and you might argue because the team is really motivated to make that happen. I think there's still that out there that's like, oh, a new team might be a good, maybe I have a slot for you.
I mean, is it purely data-driven? I mean, what's the fundamental VC value proposition now?
I mean, so again, we're a little different, but IRR and cash-on-cash return, I think, are the numbers. I mean, for us, we have a stock price and a net asset value, and so you can invest in us from a fundamental play on increasing net assets, but because we trade at a multiple to NAV, you can have 2 variables. It's had a history of going, 1x to 5x NAV, but it's not predictable. But so we really focus on, growing our net assets, and it's the same idea, but it's not, because it's not a time frame, it's a different model.
Nancy, you invest in a lot of social entrepreneurship, so is it a very different value proposition that you would bring to the table?
Well, I think that we are differentiated, and the industry it has a hard time differentiating. So that is an advantage. I mean, everyone has money, everyone works hard, everyone's smart. So having some way to differentiate yourself, as long as you have the returns or the visibility on returns, it makes it easier. And in our case, it's because we work with our companies to help them succeed by acknowledging that they have a broader set of stakeholders, and they can engage with those stakeholders, be it the government or NGOs or other sectors, in a way that helps society as it helps their business grow. And that translates into helping our companies in ways that aren't that traditional. And so the LPs look at that and say, well, we don't have one of those in our fund of funds, so it sounds pretty good. Let's give this a try.
And when it comes to the companies that you're funding, is the post-funding support very different?
Yes, it is. Certain ones are more similar than others, but we pay a lot of, we have certain goals we want to accomplish. One of them is job creation. So for companies that look like they're going to be hiring a lot of people, like Tesla did, we help them find their manufacturing sites or places to build that impact low-income communities, for example. Putting your manufacturing in a poor neighborhood helps that neighborhood rise out of poverty because you get job creation, you get lunch and dry cleaners and the multiplier effect. So, we don't force anyone to do anything, but we point out that when you move to those places, sometimes you can get free workforce training dollars, or you can get grants or various incentives from the government. So it's a win-win.
Tony, how would you answer the question of what's the VC value proposition now?
I think there's two parts to that answer. And the first part is everybody's looking for an illiquid asset class to outperform the public markets. And I think that's challenging. But I think what they're looking for in a venture capital management team is the ability to sift through on the order of 1,000 opportunities a year, pick out managers that are outstanding based on having looked at hundreds of management teams, and then help that management team succeed. I think it's really around judgment.
So it's a question of people judgment rather than data judgment now?
From the perspective of picking out opportunities, I would say it's, depending on what vertical you're in within venture capital, there's a tremendous amount of analytics that go into picking your actual niche and what you want to focus on within your niche. So that all happens beforehand. You probably, if you're on your second or third fund, you've been doing that analytics for 10 or 15 years. So you have a pretty good idea about the population of opportunity, and within the population where you think the sweet spot is. And then within that sweet spot, you look for teams that you think can execute against it.
Because one consequence of that is essentially as a fund, you keep going back to the same well, and therefore you start to build in more risk aversion in your choices.
I thought a lot about this question as it was presented in the questions beforehand. I don't think that venture capital is about risk aversion. I mean, your ability to raise a fund is based on your ability not to blow up capital, not to have deals go bust. So what you're looking for is risk management. But unless you're taking risks, you're not able to achieve outsized returns at all. You're not able to, I mean, a 30x deal or a 20x deal, if you've got one in your portfolio, that's because you took a really unusual risk and made a bet that went against the grain.
And I think your limited partners want you to do that. I mean, that's why they're in that asset class. I mean, you just have to do it well.
Yeah, I was going to say, I mean, just to add, it's the numbers, but at the same time, it is sort of that, I don't want to call it a dream, but that like concept of you can really get the 10, 20x because you go into something that's really risky and it delivers. And I think there's something about like the idea of venture capital that instills in everyone, like there's something that you can really do that changes things. It's not incremental, but it has to have that kind of investment return on top of it.
But then do you start treating it like a hits business where providing you get that one 20, 30x, that then makes up for all the...
Yeah, I mean, so I mean, that's been, I mean, so we invest in really early, really kind of out there scientific stuff, and not all of them work. I mean, we're shut down companies. Like, you have to be disciplined because you can't pour a lot of money into these because a lot of them just don't work. And you go into it knowing that, but then they do. So Solazyme, we were the first institutional investors. I mean, they make tailored sugars with algae to make biodiesel, great IPO, they're executing. You can see their stock, hopefully it'll continue to move up as they execute. I mean, Biovex was another one where, it's a virus that kills cancer cells and not healthy cells. I mean, it's really risky, but, if it works, it's going to really make an impact. D-Wave is making quantum computers. It changes fundamentally the way. And when we invested in D-Wave, people didn't really believe it was quantum. Over the years, more and more information, more and more academic data has come out to really prove that out. But you go in with a lot of skepticism and a lot of risk. And that's part of the job. I mean, that's what we do.
Nancy, is that true in investing in social entrepreneurship as well? Is that you're out there taking bigger risks in the hope that it will be a hits business?
It's definitely a hits business. I mean, I was a traditional venture capitalist for most of my career, and now doing the impact investing, it's no different. I mean, you need those big wins to cover the losses that you have in the risks that turned out to be too great, and that you have to, so you end up not getting a return or getting a marginal return. So, in a company like Tesla that has, had extraordinarily high multiples to its investors, even to its public market investors, that was a audacious idea when, back in 2006, and, lots of ridicule, lots of problems. No one took the company seriously. When they needed transmission help, they'd outsource and they get the D team, not even the C or B team. They couldn't get anyone to work at the company that came from Detroit, even though, we needed car expertise. You could just go on and on and on about all the troubles that were in that company, and it was a very tense time, as any venture investment is. I mean, most venture investments have their moments where you're looking at a potential write-off, but things happen, corporate players, new rounds, breakthroughs in the product development, and you live to fight another day, and then but you really do need some of those to really be the grand slam that you always hear about in order to make the math work.
I'm not sure that Detroit can get too many Detroit people either, which may be part of the problem. That's a separate issue. Tony, are we looking at this through a very US-centric lens at the moment? Is it different in emerging markets outside the developed ones of the US and Europe?
I think it's different in a couple of respects, but it's not different in feel. Culturally, it's almost identical. What's different is that in emerging markets, your target investee is different. There's less traditional. You don't have the Silicon Valley in emerging markets. What you have is, hundreds of family entrepreneurs that have, a cousin or a daughter or a son who's got a crazy idea and has got some backing from his family and wants to get to the next step. I think there's less pure venture in emerging markets than there is expansion stage investing, because it's got a lot of other risks in investing in emerging markets that you have to think through. Everything from government risk to all types of fraud risk and property rights risks and legal risks. So, in a sense, you need to take that into account when you invest. But I think that you see in a couple of different markets, you see the development of the beginnings of pretty strong venture investment communities in places like India and China. They're pretty developed communities of venture investing happening, but it's been slow to evolve, and it'll continue to evolve quickly.
And if you were to put a sort of lag with between say China and India and what is happening in the developed markets, does it make sense to put a number of years on that lag?
I don't know about number of years, but one of the pieces of information that always struck me, and this is coming primarily from the clean energy lens, but I'm assuming this is true for all venture investing, is the United States makes up around between 70 and 75%, or up to 77% of all venture capital investing worldwide. We do not make up anywhere near that percentage of the world economy. The next biggest venture capital market is the UK, which is 1/10 of that. And then it's like a big drop off to, say, China. Although that data is a little old, so it might not be 100% accurate, but you get the general feel for that. So in terms of years, I couldn't put a year on it, but I would say that the world economy is changing much, much faster than we can see here and feel. And I wouldn't be surprised if it changes within my career. We're one of 3 centers of excellence in venture investing, or 4.
Yeah, no, I mean, it's very striking if you look at where gets funding in the world. I mean, it's Silicon Valley, it's Southern California, it's northeastern United States. I think then the UK is 4 after that. Well, in fact, I think New York is bigger than the UK. So the international drop-off seems. I think the only thing I
would say about it, I think I can add, having now been an investor in North America for a while and then an investor in emerging markets for a while, the one thing that I always thought, what's all this crazy concentration of capital in the Valley about? Why is that? And why is this huge concentration in New York? And having watched capital be invested or participated in investments in a number of different countries right now, the one thing I can say is that the level of entrepreneurial skill in places like the Valley from repeat offenders, folks that have done 6 or 7 businesses, is really outstanding. And there's 2 parts of the skill set. There's one is the skill set is how do I build a company? And the other part of the skill set, which I think is actually more important, is the mindset. Is I can do this, I can do it quickly, I can do it capital efficiently, and I have the network to get it done. There's very few countries or very few cities that can support that type of execution.
Well, and particularly support failure. I mean, there's great entrepreneurs out there in Silicon Valley that have failed 2 or 3 times, in addition to having some good ideas. So the stigma is not there that allows for that sense of, we can do this.
Is that this sort of entrepreneurial experience that you're talking about, is that just straight experience, or is this something that can be learned and transferred? I mean, is it just time that we'll see that replicated elsewhere in the world, or is there something
I think it's
fundamentally
inevitable.
different the sort of
It's
financial
inevitable
infrastructure in the West?
that it will be replicated. It's hard to know where. I mean, it's not magic.
I mean, you
Well,
might
except
even
it takes, excuse me, it does take several decades to get it that way. And there are very few places in the world where, you can reach back to the 60s and this was happening. I mean, Fairchild, those guys went to start Intel, and Intel, that guy went to start Apple. I mean, so it's the multi-generational effect is, 5, 6, 7-fold now, and that doesn't exist many places. So that does, and that is part of the fertile nature of the valley.
So the soil's deeper.
I mean, and I would say, you can look to the United States even for similar comparisons, and a lot of regions that want to try to replicate what's happened in Boston and Silicon Valley, and they're trying to do their own economic development. And I think RTP in North Carolina is one that spent a lot of time and a lot of money and a lot of sort of thought about how can we bring in corporations, how can we build entrepreneurship, how can we create that ecosystem that's money, sort of people, ideas, good research. And I would say they're getting there, and they've probably done it better, but it's taken a long time. And even here in New York, there's a big effort to, how do we create the biotechnology environment? How do we, what do we need? How can we put it into place? And it doesn't, I think to Nancy's point, it doesn't happen overnight. And you can see, this has been a big effort here, and I think, incrementally they start to make some grounds. Here it's a cost issue. Do you really want to pay like startup money to start a company in New York City? That's a hard call sometimes. And I would make one other point about the risk. So as an entrepreneur and sort of it's okay to fail. It's okay to fail, and it's also really great to know that there's 20 other startups happening tomorrow, and if I'm doing a good job, I could probably go join one of those. And when you have an environment where you don't have a lot of that community and that infrastructure, it's a bigger risk, because you go and you know that there's the opportunity that you fail, which is fine, but then there's not that community that sort of allows you to maintain some kind of steady state of a job. And I think that's a big component to the people factor and kind of the senior management and the good management that you need to pull these things off.
Dennis Lockhart from the Atlanta Fed was alluding in his keynote this morning to some of the local initiatives that are going on to promote these sort of clusters of entrepreneurship. And I think he made the quite sensible point in New York's case is you actually have an entrepreneur as mayor, which is not common across a lot of cities, either in the US or elsewhere. But do you think it's reasonable that can policymakers actually formulate that and foster that spirit of entrepreneurship?
Personally, I think so. I think we have to put things in place, and just take New York City as an example. You need to make the price per square foot of a lab reasonable. You need to make the venture investors want to pay to stay in New York, and if it's $50 a square foot, that's a hard call when you can get it for 10 somewhere else. But there's a ton of great research here, and there's a lot going on. Especially in life science with all the hospitals and the universities. It seems like a no-brainer, and so it's the right thing. From my perspective, it's the right thing to do. It's the right thing to try to do, and it's like how do you kind of balance all of these pieces that have to come together? Because there is money, but there's not a lot of early money. There are seasoned entrepreneurs. It's just they're kind of coming at it from a different culture. And I think it's an infrastructure space. And so you see the IT booming here, media booming here. It doesn't cost that much. Whereas if you want to build a biotechnology company where you need a lab, that's harder. Although, a friend of mine, he just opened an incubator in Harlem, and his whole vision is, we want to make biotech entrepreneurship as easy to do as tech or as IT, and it's an awesome vision, and he's really tried to manage the infrastructure piece. It's new, so we'll see, but it's certainly something to keep an eye on, I think.
Nancy, is this something policymakers can shape, or does it really need to be organic from the ground up?
Well, they can definitely help create pockets of innovation and entrepreneurship. In the Bay Area, a good example of that is the East Bay, Oakland, and surrounding areas have really become hotbeds for entrepreneurship now. It's kind of started, it always starts by having a successful company start there. For example, in Oakland, that's where Pandora is headquartered, and grew from 0 people to, I think they have over 400 people in Oakland now. And so that made the city council and the mayor kind of wake up and say, this is great. We've been losing jobs everywhere else. So can we do things to help these companies? Revolution Foods is a very fast-growing company in Oakland that's serving healthy lunches to low-income schools. So it's got that social angle. And so they've created incubators. There's a new Fund Cube, it's called, that's specifically funding solar, low capital intensity businesses in Jack London Square, and getting good rents, getting concessionary treatment, getting workforce training, and all of the tools that come in an economic development toolkit can help, but it can't help without there being in a kind of indigenous entrepreneurial activity that was there kind of before.
Tony, we talked a little earlier about the increasing presence of strategic corporate investment in the field. Is this changing the way that the funds themselves work? Are they bringing a different perspective and a different set of skills?
Are the strategics bringing a different set of skills to the investment business? And honestly, I don't see that happening at this point. I think what's happening is you're seeing good, what I would call commensal relationships or symbiotic relationships between strategic investors and general partners. Most strategic investors, say there's 500 strategic investors in any given year, maybe 5 will have great venture capital units, but most don't. So what they have is they have a strategic intent from their board. We want to get access to innovation, or we want to push in a very specific direction, and so we're going to partner with 4 or 5 funds to get that done, or 1 fund to get that done. That's one way that they bring capacity and they bring interest. But I think the most important thing that most GPs will tell you is, they help address the issue of capital intensity and capital scarcity in later rounds, particularly in the energy tech space. A typical energy technology company, if it's really technology and not just process and software, it can easily cost you $50 million to $150 million to get that thing commercialized. Venture capital is usually done at 25 to 50, and then you're stretched. So who's going to help build the first plants? Who's going to help offset some of those risks? You're seeing strategics play that role around the world in the energy business.
And are they coming in and just sort of making a financial investment, or are you seeing them increasingly carry that through the exit acquisition, or is it?
It's both. I mean, in many cases, they're fully investing with the idea that they have a call option, effectively. And sometimes they've written it into their term sheet, sometimes they haven't. They just want to be able to have the option. And so if you're a strategic, let's say you're a $5 billion market cap company or $20 billion market cap company, you're a major player in a specific industry, you put $50 million out in 5 companies, $10 million each, and you have total insight into what that company does, and you think it's potentially important to your industry, you have so much more advantage than your competitors do in terms of your ability to potentially buy that company later, that you're really well positioned. So I think for them, that $10 million chit on the table compared to their typical capital spend or their typical R&D spend or their typical sales and marketing spend is nothing. It's really good. It's really efficient. It's capital
piece of corporate intelligence.
Capital efficient option for them.
Yeah. I guess I'd add just a couple of things because I agree with everything you said. The other things we've noticed are they're coming in much earlier. So we've seen, corporates in the A rounds, and we haven't seen that. I think that's probably driven by 2 reasons. One is there's not a lot of early stage money, and so I think they're getting in the early deals when before I think the traditional sort of financial venture investors would try for the most part to keep the corporate money to a later round. But because there's not so much, that's coming in. I think the other piece is, and again, because there's not as much money in the early rounds, I think in combination with corporations who are buying what they need at high prices, I think the companies that have made acquisitions and have paid up for it at a later stage, some of them, not all of them, think about how could I have done that in a more capital efficient way? How could I have done that and not spent $700 million? How could I have spent $100 million, get the same thing or the same, knowing where that's going to go? Because I'm going to have to invest a lot anyway to integrate it into my, into my infrastructure. And I think they view as, to the point of, put $10 million bets on the table as a way to try to get it earlier and cheaper. So from my perspective, where I think corporate investors and financial investors could work really well together is if up front you agree, okay, we're each going to put in $10 million and we're going to drive it to this milestone. And if that happens, you have to buy it for $200 million. So that means if you can really get to that milestone on 20 million and it's a $200 million exit, like that's a bet I would take. If I think it's going to take me $190 million to get there, probably not something I would do. But I don't see a lot of it, but I kind of wonder, I kind of question. I think there's more and more joint funds, like Avalon did a fund with GSK. There's a bunch, I would say, in the past year to 18 months where you see traditional venture investors and corporate investors coming together for funds that are very specific. And I think these kind of special deals will continue to grow.
Although there's a downside to that too. I mean, because you could be getting 200 for something that if you hung in there a few more years, you'd be getting 2 billion for. Yeah. And so it's really important to kind of assess the upside of your investment and restrict the amount of strategic involvement if you think that you've got one of these, super returning investments.
Yeah, no, I agree. It gets to kind of capital needed. Like, do you have enough capital, and then how do you manage that if you do or you don't? Because I agree.
Nancy, do you see the other end of that telescope, particularly in social investing, which is crowdsourcing as a new source of venture capital and particularly of early stage financing?
Very much so. It's a good fit for entrepreneurial early stage companies to attract money from often idealistic, crowdsourced kinds of populations, and there's not enough of a history yet to see how that's all going to play out. And it could be a big, could be not as great as people think it's going to be, but there's no doubt that there is a connection there. And there are even business plans now that are taking crowdfunding to, say, the clean tech space. There's a company called Mosaic that is basically allowing anyone to put in $25 or whatever and fund a solar project at a school or whatever. And that's a very tiny company, but it's got great partners, great momentum. So I think the democratization of access to early stage companies is a very powerful force. It's not without some pretty significant risks, but I think time will tell, and I think that we're seeing some pretty enthusiastic early signs.
Can I ask a question? Because we haven't seen it so much, but it might just be our area. Because one question I have is, if the companies need to raise more money, do they get diluted? And do they, I guess just the communication of that, I've always been sort of curious about how kind of the subsequent financing issue comes into play.
Mosaic's a lender. So you're coming in if you're coming in through their platform as an individual, you're basically buying a debt security, so you're not going to be diluted. I haven't seen as many of the venture funding platforms. Side. But we have seen, there's been an explosion of peer-to-peer lending in the last 2 years.
I think a lot of it is also done for reasons which are not driven by financial return as well. I mean, the sums involved are relatively small, and it's people wanting just to support a project because they think it's a good idea. And I think it's something that the regulatory environment is far more hospitable to in Europe than it is in the US still. So it may not have emerged as fully as it did before. I think this might be a good moment to sort of try and open this up to the floor. So if we have questions, please speak now. Yes, ma'am. Do we have if you hold on 1 second, we have a microphone. And maybe if you could also just tell us who you are. So.
Veronica Biggert. I'm representing Barry Taft in bioengineering. But My question is to both Tony and to Nancy with regards to commercialization. And Tony, since you invest in emerging markets, it seems as if a company like Tesla does well because they're able to file the patents in the US and then the market is here in the US for them to succeed. What happens when you invest in emerging market startups where they have to file patents and the patent laws are very different overseas than they are here? How do you foresee their success, in being able to cross over? In other words, it's going to be a long time before Tesla Motors goes to an emerging market because the electrical consumption or the grid doesn't support that. But if you have an innovation, in one of your emerging markets, how do you bring that technology over here?
Well, I mean, I think there's two questions in your question, one of which is do emerging market innovations transport north? And the other question is how is IP being regarded around the world and being protected? And I think we could have a whole other panel on that easily, but I think that there are parts of the world where you can file in multiple jurisdictions simultaneously or sequentially and feel pretty safe and pretty confident that you're going to be well defended. So most of the companies that we invest in that have an IP orientation, a huge portion of our investment in that company is around defending its IP and filing patents in multiple markets. One of the things that I think is probably, if I had to say what's the thing that I'm most optimistic about and the most excited about in venture and tech is actually exactly what you talk about, which is because so many emerging markets are so strapped for cash, innovation in emerging markets has to be extremely low cost and low capital intensity. So in the energy sector, in battery technology and solar technologies, in the healthcare sector in terms of medical equipment, in education in terms of delivery systems, in banking in terms of how you do mobile banking, we're seeing business models arise that are incredibly inexpensive to deploy in emerging markets. And I think about it, if it's incredibly inexpensive in emerging markets and you take that innovation and you flow it back into Europe or the United States or even developed Asia, that to me looks like a pretty great way of experimenting with business models outside of the valley and then coming back into the north and making a fairly decent return.
I would just add that our companies are headquartered here in the U.S., but many of them have global operations, and they certainly compete on an IP basis in other countries. I think it's a pretty formidable barrier if you're competing with a U.S. venture-backed company that has put a huge amount of thought and capital into its IP portfolio and has actual patents that have been granted because that this is such a huge domestic market that we're going to be able to kind of have more momentum here, and then it's going to just be hard to penetrate that armor. The flip side of that is, a lot of these solar and clean tech companies that go into China to capitalize on that growing market, that is going to be quite difficult because just of the history of copying IP. So that is something that you do with your eyes wide open, and you really have to have a lot of protective provisions and assume that many of them won't work.
I think the only thing I would add is when we're starting companies and spinning them out of universities, the IP is almost essentially its only asset. So it's something that we pay a lot of attention to and sort of develop a lot over the first couple of years.
Another question? Sir, Adam? Adam, sorry.
That's all right.
I can't see with the light in my eyes.
That's all right. It's a mistake that happens often. This is such a naive question. I'm nervous to ask it, but I was just wondering, I'm an extreme action choreographer based in New York City, and I keep dreaming there'd be a fusion market for the distribution of culture that's not just in the elitist part of our culture. And have any of you ever thought about investing on a small scale, which sort of disturbs the questions you're describing, of a social capitalist model or something that is about kind of the happiness metric that's being examined in Britain, et cetera? So we have a gross national product in the United States, I think, and a potential to really spread culture in the grassroots way that comes from a high level of investigative experimentation in New York City. I just wondered, I always wonder why there can't be a fusion idea of investment in the arts.
Well, that was one of the main goals of the founders of Pandora, was to democratize access to music that didn't come from the major labels, and gave a chance to the bluegrass band in southern Indiana to be heard across the country. And that even today is the passion behind the founder, Tim Westergren, at Pandora. Now, it gets a lot more complicated with royalty laws and needing to pay for the, get advertisers to pay for the service since it's free. But I do think that, that's one of the dominant themes in investing is personalization, whether it's going from a rotary phone to your own cell phone and smartphone, or going from a radio station to creating your own radio stations with a service like Spotify or Pandora or whatever. And it really does start with an honoring of the creative process and recognizing that what most people get is a small slice of what's out there, and it's that it's not anywhere near as representative of the scope of creativity that is, we all see around us.
Either of you want to add anything to that?
I think, look, I'm not an expert in funding in the arts, but I would say if you're looking at the venture capital industry and looking for something that's targeted towards a well-being index, I think you do well to follow sort of capital flows into impact investing. I think is really around well-being, investing in well-being, and investing in social capital at the same time as folks are making returns. I think that's an important cultural trend. I wouldn't say that if you sampled 100 seasoned general partners in the venture industry in the United States, I think you probably get 10 of them that would be able to speak about that part of the business or that investment horizon. But I think it's incredibly hopeful that that's happened, and it's becoming much more mainstream.
It appeals to people coming into the industry quite a bit as well, younger people.
You have another question?
Edmond Fondry, I have invested in a startup I created for my son, who is creating a device to fight cancer. So I am interested in this, in the situation of the venture capital in the US. What you said is that the return is rather low, but normally when you have high risk, you should have high return. So I assume that it is. What is interesting is the evolution of the returns in venture capital in this country, and how do you explain that the returns are rather low?
At the risk of taking a risk, I'll take that question, but I'm sure that my answers will be incomplete. I think one of the things that drove, it's important to understand where venture capital fits in the capital markets ecosystem. It's really early investment. Again, for a venture capitalist to succeed professionally, they have to have exits, and they're generally investing in companies that very often they're exiting before the company is generating a lot of profits. So I think in the 90s and the 80s, what generated returns for venture capital and made them outsized was the fact that public markets in the United States were really excited about tech. And you could sell your early stage company with a dribble of cash or a dribble of revenue into that market, and that was done thousands of times or hundreds of times. It's much more difficult to take companies public now, and I think that's one of the reasons that returns have been suppressed. I don't think that condition is permanent. I think there'll be many more types of investments over time, and I think personally, I think that many funds would have done well to cultivate different types of exit paths as part of their investment, part of their normal skill set or tool set earlier in their life cycles, and you would find that there are many more kinds of exits than just an IPO exit.
Well, in the asset classes, it's always been sort of top quartile that where the extreme returns have existed, And as Tony said, a lot of money came in when it was easier to be a top quartile fund. And then since the length of these funds is so long, 10-year periods, you've had indigestion, really. I mean, you had a lot of unexited portfolios in the system for years and years, and that drove down the median return that you're talking about. But it didn't mean there still weren't people out there making positive returns. They weren't as great as in the 2000 era, but there's always the returns are quite skewed to the top quartile.
And I guess what I would add is it's certainly like dependent on time. So if you look at the average holding period per portfolio company, it continues to increase, which means they continue to need more money. And typically, the longer you hold them, and assuming they're growing, they probably need more money per financing as they get older. And so all of that, I think, contributes to, and the non-access to the capital markets, although that's starting to change a little bit, makes getting the 5, 10x on a fund much more difficult. I mean, I think today if you're 2x on your fund, you're doing really, really well. And so I think, the other thing we think a lot about are what are some other creative exit models or just other models, and it doesn't have to be M&A. I mean, M&A is obvious, but how do you maybe do that better? Are there ways where you grow a company that generates revenue and you pass out a dividend? So instead of having to completely exit a company, is there a way to monetize that investment without actually having to go public or sell it, but sort of be able to regain an investment or gain an investment return on a growing company? You should be able to do that. So how can you be more creative and think a little more open-minded about that, as we know things are kind of ebbing and flowing, especially in the IPO markets?
Are you seeing any solid examples of that happening, where funds are staying in past what would normally be considered the exit date?
I mean, I know, certainly where there's a revenue generating company, very stable, and they pass out the dividends. I think, for us being public, we don't have a fund lifetime issue, but you're always going to run into the fund lifetime issue, even if you have a great company. So at some point you need to do something. But we see it.
I think we have time for just one last question, if anybody, and there's a hand over there. And there's a microphone coming in its direction.
Hi, I'm Garrett Jones, an economist at George Mason. I was curious about the rising importance of corporations as a source of VC funding. Aside from just the chase for yield, are these companies looking for something like IP or using this as a chance to scout out top managerial talent, or is there something else that's behind their quest?
What we see is that investment return is second. And it's usually a far second to having access to the technology they want. They're usually very clear on this. And again, this is not all companies. This are the ones that are really thinking about how to maintain their growth trajectory over the next 5 to 10 years. And I would say they're usually companies that really have grown a lot in the past 5 years. It's not like so they're like number 3 in their field, not number 1. And they're trying to figure it out. They're like, wow, we've been growing, we're doing really well, and we want to stay on that trajectory, and we know we need these things. And it's a P&L issue. They don't really want to make that investment in sort of the business units. And so they're open, again, this isn't everybody, they're open-minded to making an investment kind of from a balance sheet point of view. And so, but it's access to technology, and I think, to some of the other comments, there's certainly a risk if you're so beholden to them. Do you scare away other potential buyers? That's one risk. Can they hold you up if they don't want it, but you want to sell it to someone else? All of these things happen, and so I think you need to be really well aligned and really kind of clear up front. So I think you can go in really tight like that with a corporate. We've also done just straight Series A's where they're an investor alongside the strategics, and you try to get like 2 or 3, and they have no special rights or anything, and they're just along. Yeah.
I would say that it's, obviously technology is one of the more traditional reasons to do a strategic investment, but it's certainly not the only one. A lot of the strategics will make an investment to understand a portion of the market that they're not in, and maybe they're a vendor to that company, or that company is in a fast growth segment of an overall market that they're underrepresented in. So there are a lot of lenses that a strategic will use to understand how that company might increase their success. And it could be market share, it could be technology, it could be brand. There are a lot of dimensions, and technology is the traditional one, but that's by no means the only reason people do it.
Your last word?
All I would add to that is that I think that when corporates are doing venture investing, they're not thinking yield, they're thinking product development and product portfolio. When corporations are doing strategic acquisitions, which is a different type of investment, they're thinking, incremental yield or accretive investment.
I think we've reached our exit point. The clock's beaten us to it, so all it really remains me, if you could please thank your panel for their excellent insight on the subject. Thank you.